Hello, welcome to my channel. In today's video, we'll be looking at what financial asset is and also the measurement procedures of financial assets. If you haven't watched my previous video, kindly do so. In that video, we explain what the standard says about financial instruments and also the procedures about offsetting, as well as the initial measurement of financial instruments and also subsequent measurements. What then is financial assets? Before we looked at that in the previous video, but for the sake of this video, let's touch on one or two things. Financial asset, according to the standard, is any contract that gives the holder the right to claim cash or another financial asset from another entity. According to the standard, all financial assets are measured at fair value plus transaction cost, if not classified through profit or loss. What then is transaction cost? In my previous video, I explained what fair value is. So in this video, I would like to touch on what transaction cost. Transaction cost in this case can be legal charges or any costs or expense that is incidental to the acquisition of the financial asset. Now, the standard says that all financial assets must or should be measured at fair value plus transaction cost, if not classified through profit or loss. This means that when an entity classifies its financial asset through profit or loss, the transaction cost must not be added to the fair value or must not be a component of the initial value of the financial asset. The subsequent measurement of a financial asset could be amortized cost or fair value. Ifrs 9 divides all financial assets into two classifications: those measured at amortized cost and those measured at fair value. So in effect, there are three measurement options for financial assets. 1, amortized cost. 2, fair value, but here the fair value could be fair value through other comprehensive income or fair value through profit or loss. Let's take note of this. The exact measurement choice to be applied is based on whether it is an investment in debt instrument or equity instrument. Amortized cost. What then is amortized cost? Amortized cost is one of the measurement bases of a financial asset. When we say to amortize, what do we mean? To amortize means to gradually write off the initial cost of an asset over a particular period of time, or to reduce or pay off a debt with a regular payment. So to amortize, the initial amount recognized by the entity should include the transaction cost plus effective interest rate. Effective interest rate here tells how the financial asset will mature, will grow over the period of time, minus principal payments. Since it is a financial asset, the holder shall receive regular payment from another entity and also the closing balance. So this is how the amortization schedule looks like. So in the first year, the initial amount recognized, including the transaction costs plus effective interest rate, that's the rate at which the financial asset grows over the period, less any amount received by the holder of the financial asset. Then this closing balance shall be presented in the financial statement at the end of the accounting year. Then this closing balance becomes the opening balance for the subsequent year, the year that immediately follows the previous year. That's it. So in year 2, we shall begin with the closing balance of year 1. Then the same procedure follows until the last year which it is redeemed. So the number of years can extend or go further more than 3 years, but for the purpose of showing an illustration or an example, I limited it to 3 years. Fair value through profit or loss, as we saw earlier, is one of the measurement bases for a financial asset. It implies that financial assets are initially recognized at fair value with any associated transaction cost expense to statement of profit or loss. So with financial assets that are classified through profit or loss, any associated expense, that's the legal fees or any expense that is incidental to the acquisition of the financial asset, must not be capitalized. It must be written off to statement of profit or loss or statement of income. Subsequently, what do we do to the financial assets? We look at the market value, the current market value of the financial asset, and then we check whether there are gains or losses. The standard prescribes that when we recognize a gain, the gains are also to be recognized in the statement of income. Interest on investments are also recognized in the statement of income. Fair value through other comprehensive income. This is the third measurement basis of financial assets. This also implies that financial assets are initially recognized at fair value plus any associated transaction cost. So with the first one, amortized cost, financial assets are recognized at fair value plus the transaction cost. But with fair value through profit or loss, the transaction cost is expense to profit or loss. So fair value through other comprehensive income and amortized cost, we add transaction cost to the fair value of the financial asset. Subsequently, revalue to reflect their market value, and gains or losses from revaluation are recognized in other comprehensive income. So the gains or losses we recognize as a result of checking whether there are increments or decrements in the market value of the financial asset. The gains and losses are therefore to be recognized in other comprehensive income as opposed fair value through profit or loss. So financial assets that are classified through profit or loss, the gains and losses are recognized in the profit or loss or statement of income. But with fair value through other comprehensive income, the gains or losses are to be recognized in other comprehensive income. Dividend is recognized in the statement of income. That's profit or loss. So where an entity invests in shares of another company, the dividend that the entity receives must be recognized in statement of profit or loss. Let's take note of that. It must not be recognized in the statement of changes in equity. Now, as we established earlier, that financial assets can be grouped into two. That's investment in debt instruments and investment in equity instruments. Let's look at investment in debt instruments. What then is a debt instrument? A debt instrument can be bonds, debentures, treasury bills, and other views. There are a lot of debt instruments, but for the purpose of this video, an example can be bonds, can be debentures, can be treasury bills. So the standard requires that a financial asset, debt instrument, should be amortized or can be amortized when the following conditions are met. So a debt instrument, that means the following two conditions must be measured at amortized cost unless the asset is designated at fair value through profit or loss under the fair value option. Let's take note of this. An entity has the option to opt for fair value through profit or loss. But where the entity does not, a debt instrument should be amortized when these two conditions are met. The first condition, which is the business model test. The business model test. The objective of the entity's business model is to hold the financial asset to collect contractual cash flow rather than to sell the instrument prior to its contractual maturity to realize its fair value changes. So the first test the entity must pass to recognize the financial asset, which is a debt instrument, using amortized cost, is that the entity, the objective for holding the asset should be to collect contractual cash flow and also to hold it to maturity. The entity should not have any intention of disposing or selling the financial assets within the lifespan of the financial asset. So if it is 5 years, we are holding it to 5 years. We are holding it to maturity for it to be redeemed on the last day. The second one is the cash flow characteristic test. The contractual terms of the financial asset gives rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. So the last test, or the second test, is that the financial asset should give rise to the payment of principal and interest on the principal amount outstanding. The financial asset should result in or should give rise to the payment of principal and interest on principal, right? So when an entity invests in a debt, that entity is required or has the right to claim the principal amount as well as interest on the principal amount outstanding. So if an entity meets these two conditions, that the business model test and the cash flow characteristics test, then that entity qualifies to measure its debt instrument using the amortized cost. So let's take note of these two conditions. Financial assets debt instruments can also be measured through fair value through other comprehensive income. A debt instrument that meets the following two conditions must be measured at fair value through other comprehensive income, unless the asset is designated at fair value through profit or loss under the fair value option, as I already established that an entity at inception can designate its financial asset through profit or loss under the fair value option. So a financial asset which is a debt instrument can be fair value or should be fair value through other comprehensive income when the debt meets these two conditions. Here we have the business model test as well, and also the cash flow characteristic test. Let's take note, they are not the same as with amortized cost. So let's look at why they aren't the same. They are not the same. The objective of the entity's business model is both collecting contractual cash flow and selling financial assets. This means the entity will hold the instrument for its contractual cash flow, but can also sell it if need be. So with the business model test, according to the standard under fair value through other comprehensive income, an entity has the intention to collect contractual cash flow, but also has the intention of selling the financial assets. When the entity feels it is more profitable to sell, so the entity has the option to hold it to maturity, but also has another intention when it finds it favorable to sell. So as opposed to amortized cost, with the business model of amortized cost, the entity has the has the intention to collect contractual cash flow and also to hold it to maturity. But with fair value through other comprehensive income, the business model test tells us that the entity has the intention to collect contractual cash flow, but also has the intention to sell it if the need arises. With the cash flow characteristics test, is the same thing. Nothing changes between amortized cost and fair value through other comprehensive income. So we should give rise to the payment of the principal and interest on the principal amount outstanding. Financial assets, debt instruments can be fair value through profit or loss. As I've been saying for the past 3 minutes, that at inception, an entity can opt to measure its financial asset through fair value through profit or loss. All other debt instruments which fail this test must be measured at fair value through profit or loss. So with the business model test and the cash flow characteristics test, if there is any financial asset that does not meet these two conditions, then an entity has the right or the power to fair value through profit or loss. Even if an instrument meets the two requirements to be measured at amortized cost or fair value through other comprehensive income, IFRS 9 contains an option to designate at initial recognition measured at fair value through profit or loss for the following reasons. So even if the financial asset meets the two conditions, that the business test, the business model test, and the cash flow characteristic test, an entity still has the option or the right as given by the standard to opt for fair value through profit or loss. And the entity must also or must have these reasons. First one is, if doing so eliminates or significantly reduces a measurement or recognition inconsistency. Remember that we are presenting a financial statement to the users, and for comparative analysis, there must be consistency. So if an entity opting for fair value through profit or loss will enable them to give a consistent financial information, then why not? The second one is, if a financial asset is part of a group of financial assets or financial liabilities, or financial assets and financial liability being managed together. So if that financial asset is part, a financial asset itself, we can designate it to fair value through profit or loss, as measured as through profit or loss. And lastly, if it contains one or more embedded derivatives, that would require separation. So if it requires separation, after we have separated it, we can opt for fair value through profit or loss. Thank you very much.